in the pre-market today, UPS is already down by 13.58%, which means that they are currently trading at their new 52-week low of $115.61. Now, the main reason for them falling this much in the pre-market is that they cut the business with their largest customer by 50%, and well, the market doesn't seem to like that, and I'm not blaming them. But let's jump to my stock valuation spreadsheet and figure out if after this big drop in price, UPS is considered a buy. And by the way, if you want to download these spreadsheets for your own personal use, you can always do so by going down to the description and clicking on the link. Now, first, let's have a look at the dividends of the company. Their dividend yield is currently sitting at 4.87, and after the pre-market is updated, it will be sitting at about 5.5%, which is extremely high for UPS. If I jump to the dividend yield tab on Seeking Alpha and scroll down, you can see that this dividend yield is actually the highest it has been over the past 10 years, making this a great opportunity for any dividend investor. Now, jumping back, let's have a closer look at UPS. So moving to the 9-pillar analysis, the company gets a rating of 7 out of 9 with 2 pillars currently in the red. Now, let's first have a look at the 5-year P/E ratio and the 5-year price to free cash flow. The P/E ratio is currently sitting at 20.21, which would seem lower than the 5-year average, but if you have a closer look, you can see that for most of the past 5 years, the P/E ratio was actually sitting below 19. So currently, the company's P/E ratio is actually sitting higher than the 5-year average. And the reason for this is a decline in net income. From 2021 to the current time, the net income fell by more than 50%, which increased the P/E ratio. Now, one thing I do want to point out is, as you can see in 2022, the P/E ratio was sitting at only 13.40. So investors were underpaying for the company's earnings compared to what they are paying for them now. But if you were to buy the company in 2022, you would now be down by about 40%, as you can see. So when the P/E ratio is low, it doesn't necessarily mean that the company is undervalued and that is the time to buy the company. You have to look at many other factors. So let's also have a look at the price to free cash flow of the company, which is currently sitting at 18.43, which this time is actually lower than the 5-year average of 19.62 and is also lower than the average stock price to free cash flow. So UPS might actually be currently undervalued to the free cash flow they are generating. Now, talking about free cash flow and net income, let's have a look at the financial growth of the company. You can see that the revenue has grown from 2020, but from 2022 to the current time, it actually fell by about $9 billion, so by about 9%. Regarding the net income, we already know that that fell by 50%, and the free cash flow also fell from about $11 billion in 2021 to $6.2 billion in 2024. So over the short term, the company isn't doing as great. They are facing some short-term headwinds. But think about it from the long-term perspective. UPS won't disappear. They are a needed company, they are in a needed industry, and they aren't going anywhere anytime soon. So I do believe that they will grow in the next years. Now, what you have to understand is that a company can be undervalued even if they don't grow their free cash flow and net income into the future. So let me show you what I mean. If I plug in the growth rate of the free cash flow into the future at 0%, the intrinsic value of UPS will still come out at $143.54, which is higher than the current trading price and especially higher than the trading price after the pre-market is updated. So as you can see, even with 0% growth, UPS would now be considered undervalued. But let's actually calculate the intrinsic value of UPS a little later, and now let's jump back to the 9 pillars and have a look at the debt of the company. Something I always consider, especially before adding a company to my portfolio, is if with the free cash flow they are generating, they can pay off all their long-term liabilities in a decent time period while paying out their current dividends. So first, let's have a look at their free cash flow payout ratio. If I jump to pillar 8, their 5-year free cash flow payout ratio is sitting at 65.65%. But if I scroll down, the free cash flow payout ratio in 2024 was sitting at 86.90%. That is quite higher than the 5-year average, which leaves them with less free cash flow to buy back shares, pay down debt, and invest back into the business. But if I move to pillar 9, you can see that the long-term liabilities over the 5-year free cash flow negative dividends is actually sitting at only 2.18. So the current long-term liabilities of UPS are sitting at 30 billion. If I jump to pillar 5, you can see that in 2024 they generated 6.2 billion in free cash flow. So with the free cash flow they're currently generating and with the dividends they are currently paying out, it would take them about 10 years to pay down all their long-term liabilities, which is quite fine with me. So even with their higher free cash flow payout ratio, in this sense, I'm not really worried about UPS. But now let's have a look at one final metric, and that is the 5-year profit margin, which is sitting at 8%. But again, if I zoom into pillar 6, you can see that currently it is sitting at only 6.35% and has been decreasing by quite a high amount over the past 5 years. And not only has the profit margin been decreasing, but the return on invested capital has been decreasing as well, currently sitting at only 11.67%. So obviously this isn't great, but as I said before, even with decreasing financials and decreasing profit margin, the company can still be undervalued. So let's now calculate their intrinsic value. Jumping to the Graham's formula, I will predict the high earnings per share growth at say 12%, medium at 10% and low at 9%, and averaging it out with the analyst predictions, we will get the 5-year earnings growth estimate at 12.81%. And combining that with all the other values, plugging it into the Graham's formula revised, we will get an intrinsic value of $212.53, which is 37% higher than the current trading price. I mean, this shows me that the company is very undervalued compared to the earnings they are currently generating. Now, jumping to the discounted cash flow model, which we already went through, but as I do believe that their free cash flow will grow, I will plug in the high growth at 8% into the next 8 years plus, medium at 7 and low, let's go with 5. And after plugging in a discount rate at 7%, we will get an intrinsic value of $250. Now let's also compare UPS to 3 of its competitors. After averaging out these 3 competitors' P ratios and multiplying by the earnings per share of UPS, we will get an intrinsic value of $115.21, which this time is a little lower than the current trading price, but is probably very close to the price after the pre-market is updated. Now jumping to the final valuation model, the dividend discount model, I will project the dividend growth at 5%, 4%, and 3% into the short term, as I do believe that UPS won't generate enough free cash flow to raise their dividends by too much. So I will project the growth rate at 4%, and with the discount rate of 7%, we will still get an intrinsic value at $227.90. And finally, when we average out the 4 valuation models, we will get an intrinsic value of $201.43, which is 50.5% higher than the current trading price before the pre-market is updated. So with a margin of safety of say 40%, we would get an acceptable buy price at $120.86, which is well in our buying range. And with that, let me know down in the comments if you are buying, selling, or holding UPS. I am personally considering adding the company to my portfolio after their today's big drop. And with that, make sure to leave a like and subscribe as it really helps me out.